What if the market told you exactly when it was about to turn? Not with complex charts, but with a simple pattern. A winning streak. Right now, the S&P 500 is putting together one of these runs. 4 straight days of gains, pushing near an all-time high. But what if this streak isn't a signal to buy, but a final blinking red warning sign, a warning amplified by a number so big it's almost impossible to understand? $38 trillion. The weight of America's debt. This isn't just about Wall Street. This is about your 401k, your job, your mortgage. We're going to connect the dots between a simple market pattern, a mountain of debt, and the question, are we in the final bubble before the burst? Let's break down the streak. From December 2nd to December 5th, 2025, 4 days in a Roth S&P 500 went up, plus 0.25%, plus 0.30%, plus 0.11%, plus 0.19%. It closed at 6,870, just shy of its all-time record. On the surface, this looks like good news. The economy is humming, tech is strong, confidence is high, but there's a hidden math to this, something traders call market streak theory. Think of it like flipping a coin. In a random world, the chance of 4 heads in a row is just over 6%. But the market isn't random. It's driven by human emotion, greed, fear, herd mentality. Studies show that after an up day, there's a 78% chance the next day will also be up. Momentum breeds momentum. Winning streaks cluster. This 4-day run is a classic example. It feels great. It builds confidence. It makes people think this train isn't stopping. History tells a tricky story. Short streaks often mean bullish momentum, but longer, extreme streaks. They've often been followed by a reality check, a reversion to the mean. Because overconfidence sets in, people start borrowing money to chase the rally, and that is where this story turns dangerous. While the market was celebrating its 4-day party, the U.S. national debt quietly passed $38.4 trillion. That's $115,000 for every person in the country, growing by over $6 billion every single day. The title mentioned $36 trillion. That was accurate just a few months ago. The climb is that fast. So how does this connect to the market streak? It's the fuel. When the government borrows and spends at this scale, it keeps money cheap. Cheap borrowing floods the entire system. Companies borrow to buy back their own stock, pushing prices higher. Investors borrow on margin to buy more than they can afford. This leverage turns a normal market into a bubble. And here's the proof. In September 2025, margin debt hit a record high, $1.13 trillion. Margin debt is money investors borrowed to buy stocks. Look at this chart. See the previous peaks, 2000. Right before the dot-com crash, 2007. Right before the housing crash, 2021, before a major correction. This is the kindling, a market winning streak. Fueled by borrowed money, sitting on top of a $38 trillion debt base, let's run a bubble checklist, using history as our guide. Extreme valuations. Check. Much of the rally is driven by giant tech and AI companies. Their prices assume perfection years into the future. This time is different narrative. Check. We're told, AI changes everything. Old rules don't apply. Sound familiar? Internet in 1999. Housing never goes down in 2006. High leverage in the system. Big check. We just saw the record $1.13 trillion margin debt. A spark. That's the unknown. The debt itself could be the spark. Corporate default risk is at a post-2008 high. If the government pays higher interest on $38 trillion, that money comes from somewhere. Slowing the real economy, the streak math says momentum can continue. But the debt math says the foundation is cracking. When a market is this leveraged, any dip can trigger margin calls. Investors are forced to sell stocks to cover loans. That selling triggers more selling. A vicious, self-feeding cycle. That's how a 5% drop becomes a 20% crash. So is a crash guaranteed tomorrow? No, markets can stay irrational longer than you can stay solvent. Some analysts even see the S&P climbing another 4%. But the risk isn't about tomorrow. It's about the shift in probability. This streak is happening in a fragile, over-leveraged environment, more indebted than almost any point in history. That means corrections can be bigger, and the tools to fight them are weaker. This isn't fear, It's awareness. So what should you do? Don't panic sell, but review your portfolio. Is it diversified or all in high-flying tech? Know your timeline. If you need money in 2 to 3 years, it shouldn't be in the stock market. Tune out the noise. Ignore hype and FOMO. Greed is loud, prudence is quiet. Watch the signals, not the streak ending, but a break in the debt trend. Or a sharp drop in margin debt. Those are the real warnings. The 4-day winning streak will be forgotten, just a blip in market history. But the $38 trillion debt will not. It defines our generation. The streak math shows the optimism. The debt math shows the cost. The question is, when will the second bill come due? The patterns are there. The math is clear. It's up to us to decide if we're listening.